of this year's conference, which is the first one we're having virtually, and the 9th, in the edition. We have a very loaded agenda, and my expectation is, as engaging as yesterday was, we can make today even more engaging. Our focus here is to go away with thoughts, that can lead to market advocacy initiatives, right, after this conference, with the overall objective of making our markets better. I think we're very pleased to have AACN from IMF here, who's going to tell us more. There's always been this, positivity about Nigeria, huge opportunity. So I would like to wish each and every one of us a much more engaging day with very stimulating conversations. If you look at the panel discussions we've got for today, there's a panel discussion on the exchanges, another one on the CSDs, and another one on the on cybersecurity and co, given that everything is now virtual. So I want to officially welcome everyone one more time and wish us a very fulfilling second day. And I do hope that at the end of today, we're spending roughly 3 hours together, it will be time well spent, and we'll go away with key initiatives that will make our market a better and more attractive market for the investing community. So feel welcome, everybody. We hand over to Ari, to talk us through some of the views from the IMF, on Nigeria. Ari, over to you. I know today is on standby. Thank you, ladies and gentlemen.
Hello, I hope you can hear me, and I'm sharing my screen, so hopefully you can see the screen. Can you?
Yes, we can, Ari.
All right. Okay, well, first of all, let me thank you very much for the Association of Asset Custodians of Nigeria for the invitation to speak at this Investors Day. And as the topic is macroeconomic developments and outlook for Nigeria, I hope that through this presentation, as the MC just said, it can stimulate some reflection and discussions on such an important topic for the country. So without further ado, let me just start this. Let me here. I think that we can start with some background that is useful for how we are seeing the economy, or how 2020 ended up, right? So because of the COVID-19 pandemic and a forced stop of economic activity, the Nigerian economy contracted by 1.8%. That was actually a little better, much better than originally we were expecting. And there was a positive surprise in Q4 2020 when the economy started to recover. Nigeria was not different from various countries in the world. Most of them in the world presented a contraction. There are some exceptions in the region, Egypt, Ghana, but you take other oil exporting countries like Angola and other countries in Africa and elsewhere, I think the experience of Nigeria is not very different than most of the countries. A subproduct of this contraction is the high unemployment rate, that unemployment increased to very high levels in the fourth quarter of 2020, and particularly youth unemployment that reached above 50%, which is of course very concerning, particularly given the demographic growth of Nigeria. Inflation has also increased driven by food inflation, and it reached close to 20%. And now is starting to decelerate. Last month it went down to 18.1, and yesterday we got results 17.9. Still elevated, of course, but already decelerating. Last year was a year where deficits increased, as there was a need to support the economy, and the Ministry of Finance put together a package for health-related and COVID-related stimulus to the economy that has driven the deficit of the public sector, overall fiscal balance, to almost 6%. That was also followed by a current account deficit in 2020, a little higher than the one experienced in 2019, despite the fall in imports. And this is simply because the global economy did not perform well, and the Nigerian exports suffered a lot, particularly oil, and the price of oil really collapsed last year. No? Public debt, as a result of this increase in deficit, public debt has increased to 35% of GDP, still a moderate level. And as a result of this context, we did have some downgrades by S&P and Fitch in the beginning of the year, and then an affirmation later on by Fitch and Moody's, and the rating agencies seem to be now on a standby in terms of their rating movements. Good news is that in 2021, the global economy is recovering, and it's already recovering fast in several countries. For example, China is projected to grow above 8%. Even the United States, we have here 6% according to the World Economic Outlook, but projections are higher. Some are saying 7.5%. So the world economy is projected to grow at 6%. And emerging market and developing economies would continue to lead, although even advanced economies, as I just mentioned, the United States, are projected to have a very strong performance, even the euro area, with 5%. Part of it is the collapse of last year growth, but the recovery also has been very fast. As fast as it collapsed, as fast it's recovering. And although you do see differences among countries, and it's something to pay attention in terms of how synchronized this growth recovery is among countries. Nigeria, the positive signs are also there. We saw in 2020 Q4 the beginning of a recovery, then in 2021, 0.5% year-on-year increase, supported by agriculture and services. Still an incipient recovery, still fragile, and therefore, yes, good news, but of course, it's not yet a strong recovery. You can see also the momentum changing in the Purchasing Manager Index on the right chart, where you see already the whole economy already in the positive side, above 50, which means that the economy, according to these surveys, would be expanding. Even those PMIs compiled by the CBN also project an improvement, particularly in manufacturing, already happening. So these are positive news for Nigeria. And a lot of this is still related to the rising oil prices. As you can see, there is a huge recovery in oil prices to actually pre-pandemic levels now. And it's true that oil production makes only about 10% of the Nigerian GDP. But we have done some analytical work at the fund, and we show that there is a strong correlation between oil price and the growth in other sectors. That is the case most likely because of very important spillovers to non-oil, non-agriculture, and non-ICT from oil price increases. So all other sectors in the economy seem to benefit in this, if you wish, quadratic form towards oil prices. So with the recovery of oil prices, GDP growth is also recovering in Nigeria, and it's likely to continue in the next quarters. What is our projection at the moment? We are projecting growth of 2.5% in 2021. And this is going to be led by non-oil, non-agriculture. Part of it is, as I said, 2020 was a very bad year, particularly Q2 and Q3. Base effects are going to be very favorable because the growth rates in those quarters were very low last year. So we have very, very favorable basis for Q2 and Q3 of this year. No? So that is a statistical issue, but also there is some momentum with oil prices supportive that the whole economy could see major higher growth. And this could be broadened among sectors, not only agriculture, services, ICT, but other sectors of the economy could grow as well. Now we need to keep into perspective this 2.5, population growth at 3.2, or some would say 2.6, let's say, would still not be enough to have a growth rate in income per capita. And this is important to keep in mind because that's a socioeconomic indicator that would reflect conditions, living conditions, lives and livelihoods here in Nigeria. So Nigeria needs much more growth than the 2.5. Nonetheless, it's a positive development that the economy is recovering. To give that perspective, for the medium term, we are still not looking into very high growth rates. It's still subdued. So what you have in the right-hand side here is the medium-term growth. So you see 2021, the projection is for the growth, for the GDP level to return to pre-pandemic level, right? And then the growth rates we are expecting are similar to those we were expecting before, in fact, of the pandemic. But you have a gap in terms of the amount of GDP that actually was lost. And this is important to keep in mind, as I said, with the high unemployment, some are suffering more than others, and there is some lost output that stayed there, that it will be recovered, but we will not be able to recover to the projection path that we were having for GDP prior to the pandemic, unless this blue line that I have here would shift its inclination back to the black line. That's not what we are expecting yet. So it's something important to keep in mind. What are the risks to this outlook? The risks are mostly on the downside. And first, the COVID. COVID-19 still represents a risk, particularly the variants that are in the region and in India. And we see cases increasing quite dramatically now, again, in South Africa, Zambia, Uganda. So that is something to keep in mind. Thank God for now, the situation in Nigeria is safe for now, but we could not rule out a possible surge of cases and discussions on possible lockdowns, which I hope don't happen. No, access to adequate vaccine would be very important in these circumstances, and surpluses that would come from other countries would be actually extremely helpful for Nigeria and for other African countries with still low access to adequate vaccine doses. Another risk is the security challenges. They could become macro-critical because of their effects in GDP, on food inflation, agricultural production, and movement within the country. So certainly something to watch as the security challenges evolve in Nigeria. High inflation if it's sustainable, as it's been high for quite some time, it weighs down on domestic demand and consumption because it reduces real incomes of households and families. Foreign exchange shortage and uncertainties in that segment, particularly foreign investors stay away for too long, and we'll see a chart later of what I'm referring. It's important for external sustainability to be able to have the balance of payments fully funded. Finally, there are upside risks, and here I would like to mention two. First one is Dangote refinery and the petroleum industry bill. If it passes parliament and if it's the last draft is in a good shape, this certainly would contribute to boost confidence in the sector, and additional oil production and investments would happen in that sector of the economy, with spillovers, particularly from the refinery, into other sectors of this economy. And also helpful for the balance of payments, of course, considering that this refinery could eventually even export. Other upside risk is if there are more decisive reforms, both on the revenue administration side, raise revenues, but also on the foreign exchange reforms to increase availability of foreign exchange. I want to continue a little more. If I know how to move, for some reason it's stuck. Here it is. And discuss full subsidies, which is an area of concern for the IMF and for the team working with the IMF. You see that since March 20, as we said, oil prices have been recovering. And more or less at the end of last year, oil prices went above the PMS domestic prices here in Nigeria. That immediately raised the amount of the prospect of someone needs to finance the difference between these black and blue line, because these are subsidies, as the prices here in Nigeria are not following international prices of oil and the exchange rate. So the kerosene, yes, it's up there, higher than the Bonny Light price, which I'm using here as a reference. And in the right chart, you can see that since January 2021, there is an accumulation of these blue bars, which are the total subsidies that have been accumulated and paid for until certainly May and April. We do not have yet hard figures, so these are estimates, but we are already estimating, if things don't move, what is going to be the cost of financing this implicit subsidy. And it's going to be tangible and concrete of about $100 million, 100 billion nairas, sorry, per 100 billion nairas per month. Also interesting to see that the PMS subsidy is a little higher than the total, because other fuels like kerosene have a higher price than Bonny Light. So it actually gets more revenue. The truth, though, is that PMS is typically consumed by richer households, aside from public transportation, compared to kerosene that in many ways is consumed by the poorest segments of the population. So what we are seeing here is also a cross subsidy. And in fact, all this subsidy is quite regressive, and it's a concern, because it's taking away fiscal resources that could be used to support some of the less favored or most vulnerable segments of the Nigerian society. Sorry? Okay, someone needed to talk, but I will continue until the end. So this is an area of concern for us. Another area particularly because of the fiscal pressures, not only from the increased subsidies now, but also security spending, given the security challenges in the country, and the payment of debt services, which is taking quite a bit of the revenues. Very little space is left for infrastructure spending and social-oriented spending. And these financing pressures are going to be felt by additional debt that will need to be issued, but also, and here is a risk, of CBN, the Central Bank of Nigeria, needing to provide an overdraft for the Treasury to finance additional spending. So here we see until 2020, it was a sizable amount of the financing of the Treasury. During the pandemic, some is understood, but as we hopefully move away, it will be important to adhere to the legal limits of central bank financing to the Treasury. So this is also an area that is in our radar. As I said before, the issue of foreign exchange shortages is real, and the question here on external stability, you have this red line, which is the total imports of the country, and until the pandemic hit, they were basically being financed through the various windows, particularly the INE window, who has been the exchange rate window most active. But since the pandemic hit, you see that that window and most of the foreign exchange supply was not there to finance those imports. And that raises a question. Those imports that are happening, they are finding financing elsewhere. And the question then becomes how sustainable those imports can be made over time if the availability of foreign exchange is not going to be provided locally through the INE market, but elsewhere. So that is a question that is also something very important, particularly because foreign exchange will be required to import inputs and others to be able to help investments and the development by the private sector of GDP growth. Finally, monetary policy. We see here some, with the excess reserve ratio declining a little bit, some recovery in private sector credit growth, still not very high, less than 10% year-on-year growth at 3-month rolling window. But so that growth is not very important. So that poses the question, is there a tightening or not? And here you can see some elements of yes, private sector credit is not very robust. Reserves through the CRR have been increasing, and the central bank is taking some liquidity out and not leaving as much to banks. On the other hand, the lending and deposit rates of the central bank are less than the inflation rate, so real rates are in fact negative today because it's about 12%. So it's still supportive, one could argue. At the same time that bond yields started to increase, not to the levels of the inflation rate, but certainly much higher than they were late last year. And you already can see about 10%, 8 to 10% in the 5 and 10-year bond yield. So it's a question how tightened things are. The central bank is also supporting the economy through various programs it has. We think of these as quasi-fiscal activities, and some of them perhaps were important to support the economy during the pandemic, but there is an issue how long some of these activities will continue as the central bank is focusing in multiple objectives and with multiple instruments, while our view is that the primacy of price stability is the main mandate and focus of the central bank. I will stop here. I hope this was useful to our discussions today, to your discussions today. And I thank you very much for your attention, and additional information, including this presentation, will be made available in our website here in Nigeria. Thank you very, very much for your attention again.
Thank you very much, Ari. Thank you so much for the presentation. Okay, so before I start asking the questions, I think it's best for me to introduce myself. My name is Adebola Adedeji Lawani, and I will be taking us through some of the sessions today, just like T-Match did yesterday. So we have some questions already, Ari, and I think we should just jump straight into them.
Somebody Major Bay or something like that.
Hello, Harry, can you hear me?
I can hear you.
Okay, so if you have any questions, you can just post your questions on in the Q&A section. And if you want to ask your question live as well, I think we can allow that as well. So you can just
link Zoom.
And we'll be able to allow that. Okay, so let's take the first question we have already. It says here that, do you see the possibility of China investing continuously in Nigeria's economy, and what possible effects can it have for the Nigerian economy?
Okay, thank you for the question. Certainly not only Nigeria, but in other African countries, China has been an important partner, particularly on infrastructure. Sorry, I guess. Is there someone else that wants to speak? Okay, I will continue. So China is a very important country and is investing heavily in Africa. And Nigeria certainly offers opportunities. And Nigeria also has some needs, a need to attract investments. So I think China is and could be a very strong partner in the way participating on Nigeria development and growth going forward as the opportunities evolve for its participation. It will be important, of course, to adhere to disclosure and good practices on borrowing and lending to make those Chinese investments productive and transparently seen within the Nigerian economy. And I'm sure that this is the way that all parties involved would try to adhere to the best practices on transparency.
Okay, thank you for that. We have Abiodun's hand up, the AACN president. Abiodun, do you want to unmute and ask your question before I take the second one from the Q&A?
Sure. Thanks so much, Adebola, and thanks, Ari, for that very insightful presentation. I mean, my question, I asked a similar question to David Cohen, the Citibank economist, yesterday when he was presenting around IMF's projection, for Nigeria GDP growth. And I heard you saying clearly that even at 2.5%, Nigeria is supposed to be doing much more than that when you look at the demography and all of that, which I quite agree with. And while you were presenting, I know that as of this morning, crude oil is now over $74 per barrel. But aside from getting the FX right, okay, what other things would you be suggesting, for the Nigerian authorities to do? I remember back those days when Nigeria was growing at 6.5, 7% per annum. So in your view from IMF perspective, what I've noted FX and of course dependence on crude oil, right, for foreign exchange. But what other things, and also removing subsidies? I know you spoke about subsidies, right? But are there other things you would prefer as solutions that could really accelerate the GDP growth rate, you know, that Nigeria is currently seeing? I've seen a number of other economies growing faster than they were, you know, before the pandemic, but Nigeria still seems to be dragging the rest of the African continent. Thank you.
Okay, excellent question, and it gives me an opportunity to touch base on another question from the chat on the African trade agreement. No, so let me try. This is an ample question, and let me start by saying that macroeconomic stability is an important ingredient to restore confidence of investors. I'm not talking only about portfolio investors. That's certainly not what I have in mind as the most important, but certainly FDI and even domestic investors. And macroeconomic stability, low inflation, a little higher growth, less volatility is extremely important for investors and for the confidence to give visibility and a predictable horizon for investments to mature in any economy. So macro stability, achieving low and stable inflation and promoting growth remain and reducing volatility remain essential. But they are not going to actually do the trick. You know, they are a necessary condition, but they are not a sufficient condition for higher growth rates. And here I would like to mention additional things. First, reliance on oil. A lot of the cycles that Nigeria observes follows oil prices. So the Nigerian economy, also from a macroeconomic point of view, would have to be much more resilient against those shocks. And for that, dependence on oil needs to be reduced and the economy to diversify, right? Now that's easier said than done. How do you diversify an economy when most of the capital is actually flowing to the most productive sector with higher prices, which are oil prices? That's a difficult thing to do. But the objective should be clear that diversifying the economy would provide very good dividends for this economy. Also in terms of the resilience to external shocks with oil. Now, if you manage to diversify this economy and the entrepreneurship, the talent that you see in Nigeria already shows how possible could that be in terms of the ICT sector, digitalization, even agriculture, techniques that are being developed. So I think that there are many sectors that eventually, manufacturing, that will eventually be able to develop to try to diversify the economy. How to get there and maintain macro stability is always a question, but I think the objective is there. Now, why is it important beyond the resilience in the macro? Is to take advantage of huge markets, not only in Nigeria, but abroad. Nigeria is a huge country with a huge consumer market, 200 million people living here. But if you take beyond Nigeria, suddenly Nigeria could have economies of scale that go even beyond its own borders. That's why it's so important to focus on trade and integration, because it would allow more scale for Nigerian producers to take advantage of other markets in the region. So these are some of the things that we believe would be helpful. A more export-oriented type of support rather than inward-looking orientation of import substitution most likely will be positive for Nigeria, recognizing that the public sector would not be able to be the biggest engine of economic growth, but we need the private sector and a conducive business environment and remove of all the obstacles that can be removed so that business environment is helping the talent flourish even more and contribute to economic growth and development in Nigeria. It's all about confidence, good policies, and a good environment. Investments would come back eventually, and we could see again high growth rates as we saw in the past. But reforms would need to be made, and this is one of the positive upsides. If reforms are decisive, and if they can resolve the issue of foreign exchange availability, more tax revenues can be increased. This is very important because on that part, we will need investments in skills, you need investments in infrastructure. It's very easy to talk about private sector development, but you need energy, you need talents. So for that, you need human capital, physical capital. So it's important that the public sector is able to leverage social and infrastructure investments. And for that, you need fiscal space. So more revenues is a critical element on this. Nigeria is today the country among the countries with the lowest level of tax to GDP ratio. So that issue somehow needs to be resolved, and more revenue would be required to invest in priority sectors. Okay, I have spoken too much, but I hope that answered the question.
Yeah. Well, there's an additional question now as a fallout of your answer to the last question. Someone just typed in the, Bumi just typed in the Q&A that I hear you mentioned our demography as a factor for growth and development. What can Nigeria do to harness this demography in the short term and inclusion in the future?
That's a good question, and I am not an expert, so I will admit that. We have other people who know better on particularly I'm thinking here, UNFPA, when they do their projections on population growth for all countries in the world. They certainly have recommendations of the type of family planning and education that, you know, and that would allow perhaps decisions at the household level to be taken in such a way that the demographic growth is not explosive. Having said that, there is a positive element to having strong population growth. You know, some countries suffer from the other problem of not having enough population growth, which is needed for economic growth, and one would say that eventually will allow demographic dividends to accrue to Nigeria and to other economies in Africa. But for that, you know, the pace at which demographic growth will put pressure on fiscal existing resources certainly needs to be balanced against those eventual dividend, demographic dividend that will be available. So it's all a question of how much demographic growth is needed at the moment, and how best families can plan to be able to ensure that their kids will have enough to be able to grow and be productive and contribute to the process of economic growth in the country, and how much the fiscal authorities and the private sector will be able to provide the skills and opportunities for those new generations that are coming. They can find jobs, the new entrants to the job market. So it's all a question of these things working together so that income per capita can increase, not only GDP growth as a whole, because income per capita, and not even that only, the distribution also of income among all the segments of society can actually improve, because even income per capita is an average and it should grow. It's not growing now, but even that one is not going to guarantee a more even, if you wish, distribution of income. We do not need the perfect distribution of income, which is not the question, but a more inclusive approach would require involving the most vulnerable sectors so they can participate in economic. Thank you.
Thank you very much, Ali. Thank you. I think you've done a wonderful job this morning, and thank you so much for your time. We will go straight to the next session, where we will be talking about the future of financial markets. And first, we have the Chief Executive Officer of the FMDQ Group, Bola Onodele Koko, who would take his presentation first. And right after that, we are going into a panel session, and that will be moderated by the President of AACN, Yodon Adibikwe. Thank you.
All right, thank you very much. And good morning, distinguished ladies and gentlemen. On behalf of Mr. Bola Onodele Koko, the Chief Executive Officer of FMDQ Group, who has asked that I extend his apologies for his inability to attend this event, I'm deeply honored to present his speech at this Nigeria Investors Day 2021 conference themed Nigerian Capital Markets, the Road to the New Normal. While I recognize that the expectation may be for me to focus on the future of the Nigerian financial markets, especially as we, alongside other economies of the world, recover from the rather devastating effects of the COVID-19 pandemic, I must make the upfront disclosure of how attempting such may lead to many inaccurate assertions, however useful. Instead, I will be challenging us to think in decades by reflecting on the growth and historical resilience of the Nigerian financial markets, to the end that we may together envision what is possible in the coming years. I therefore commend the Association of Asset Custodians of Nigeria for organizing this conference and giving us an opportunity to reflect and exchange ideas regarding the future of our market. As the financial crisis of 2008, now known as the global financial crisis, ravaged the global economy, the prices of crude oil declined sharply as the demand for crude oil fell. The price of Bonny Light crude went from about $138 per barrel in June 2008 to $44.9 per barrel in January 2009. And Nigeria, being a commodity-dependent economy, was not insulated from the effects of this crisis, experiencing a drastic decline in export proceeds from crude oil. Capital flight from the economy as the risk of global recession was high and consequent fall in equity prices. The crisis took the peculiar characteristic of a banking crisis in the years that followed in Nigeria, as Nigerian banks had circa 1.6 trillion naira in exposure to both the oil and gas sector and the equity market via margin lending. The asset quality of the Nigerian banks declined significantly as non-performing loan ratio of banks skyrocketed from about 3.7% as at the end of 2008 to circa 20.2% by September 30, 2010, with its attendant economic consequences. To avoid a systemic failure and revitalize the banking system, the Central Bank of Nigeria, in conjunction with NDIC and the Federal Ministry of Finance, injected 620 billion naira into the banking industry and established the Asset Management Corporation of Nigeria, AMCON, in July 2010 to acquire eligible bank assets through the issuance of bonds. Beyond these decisive actions, and perhaps more importantly, Nigerian banks took numerous actions under the guidance of the central bank to improve transparency, internal governance, and risk management. Another major development was the introduction of a new banking model in 2010, under which banks were required to divest from their non-banking assets and subsidiaries to focus on the core business of banking. While the equity market may still be recovering from the effects of the crisis due to the losses suffered by investors, the banking system, a critical component of the Nigerian financial market, survived the crisis and has emerged stronger with more robust corporate governance and risk management practices. To further support the development of the Nigerian financial markets and ensure financial system stability, the CBN also released the guidelines for FX derivatives and modalities for CBN FX forwards in 2011. What followed was a period of unprecedented growth in the Nigerian banking industry, as total assets grew from 15.3 trillion naira in 2008 to about 41 trillion in 2019. And the NPL ratios reduced to about 6% at the end of 2020. Overall, the reforms led to improved levels of liquidity, capital adequacy, and satisfactory asset quality. In addition to these, the establishment of FMDQ OTC Securities Exchange in 2013 ushered in transparency and market governance in the fixed income and currencies market. The company has since evolved into Africa's first vertically integrated financial market infrastructure group, FMDQ Group, and a critical part of the financial market ecosystem in Nigeria. The next point of significance in the last decade I will be speaking to is the foreign exchange crisis of 2015 to 2017, a period when the Nigerian financial markets experienced illiquidity and uncertainty in the FX market. This was caused by a combination of a slump in oil prices and sharp reduction in the volume of crude oil produced, leading to 5 consecutive quarters of economic contraction, beginning in the first quarter of 2016, Nigeria's first economic recession in 25 years. The impact this FX crisis had on the Nigerian financial markets and the economy in general revealed the inadequacy of the market structure introduced during the crisis and risk management products, to which the central bank responded by revising the structure of the interbank FX market in June 2016 on the back of the release of the revised guideline for the operations of the Nigerian interbank FX market. The revised guidelines approved an additional hedging product, the Naira settled OTC FX futures product. The implementation of the guidelines was challenged, leading to the introduction of investors and exporters FX window, known as the I&E FX window, in April 2017, which essentially transitioned the market to a more liberal FX regime. While the I&E FX window saw a remarkable improvement in foreign investor participation in the FX market, the ability of these investors to hedge their FX risk and preserve the capital through the use of the OTC FX futures contracts played a significant role in supporting the stability that the Nigerian FX market enjoyed between 2017 and 2019. The GDP recovered from a contraction of 1.58% in 2016 to a growth of 0.82% in 2017. The recovery, buoyed by a well-functioning FX market, continued till 2019, where GDP growth was at 2.27%. Through these market stresses and occasional setbacks, the Nigerian financial markets have continued to grow, both in size and product diversity. The bond market is a case in point. Over the last decade, the turnover of FGN bonds increased from about 7.9 trillion naira in 2011 to over 28 trillion naira as of 2020. Beyond the increased activity of the bond market, the last decade also saw one of the productive product diversity and many debuts. One, in 2011, the FGN issued Nigeria's debut Eurobond, a 10-year, $500 million Eurobond that was 2.5 times oversubscribed. This issuance, in addition to providing budget support to the federal government, served as a benchmark instrument to guide the pricing of Nigerian corporate Eurobonds in the international market. Following the successful issuance of Sukuk bonds by the Osun State government in 2013, the DMO introduced the sovereign Sukuks into the domestic financial markets. In 2017 and 2018, the DMO raised a cumulative sum of 200 billion naira. In June 2020, a much higher amount of sovereign Sukuks was issued, 162 billion naira. A decade after the issuance of the world's first ever labeled green bond in November 2008, the FGN issued the first green bond in Nigeria in 2018. This was swiftly followed by 2 corporate green bond issuances in 2019, with a cumulative size of 65 billion naira. Finally, in 2019, the FGN issued its debut 30-year local currency bond, which extended the yield curve and was over 4 times subscribed. The last decade has also seen the participation of local investors in the Nigerian financial markets increase significantly due to increasing domestic savings and capital accumulation. Today, pension fund administrators are among the most significant institutional investors in Nigeria, as the assets under management of the pension industry grew by a compounded annual growth rate of about 19.7% from 2 trillion at the end of 2010 to about 12.3 trillion as at the end of 2020. The net asset value of collective investment schemes have also grown by a CAGR of about 33.6%, from 83.4 billion to over 1.5 trillion over the same period. As 2020 began, there were major concerns regarding the continued vulnerability of the Nigerian economy and financial markets to global disruption and the potentially devastating effect of the COVID-19 pandemic. I must say that the concerns soon became valid as the pandemic which commenced in Q1 2020 led to synchronized shutdown of the economy as the Nigerian government imposed a countrywide lockdown akin to what was announced in different countries. The reduced economic activity and consequent decline in the demand for crude oil, in addition to the supply glut occasioned by the disagreement between OPEC and its allies, one, pushed oil prices below production cost levels, two, increased fiscal pressure, which led to the downward revision of the 2020 budget, as the pandemic had sharply curtailed both oil and non-oil revenue streams. And three, led to a 77.8 year-on-year decline in capital imported into Nigeria as at 2020 Q2, as foreign investors chose to invest in safe haven assets rather than emerging and frontier markets amidst the rising global uncertainties. While these may have been the major highlights, I must at this point discuss two major stimuli received by the Nigerian financial markets over the same period. The first is a two-in-one regulatory stimulus. The Securities and Exchange Commission released two sets of rules in December 2019. The rules on the regulation of derivatives trading and the rules on central counterparty. While the rules on the regulations of derivatives trading provided the necessary regulatory framework to support the broader application of derivatives beyond the FX market in Nigeria, the rules on CCP set the regulatory environment for the establishment of a CCP, which is a critical market infrastructure for the aggregation and management of counterparty risks in the derivatives market and beyond. These rules will serve as tailwind for product diversification via the development of non-FX derivative products in Nigeria and encourage much desired counterparty agnostic trading, which will boost trading liquidity and improve capital efficiency in the Nigerian financial market. The second, which is the repeal and reenactment of the Companies and Allied Matters Act, CAMA 1990, as CAMA 2020 in August 2020, is the legal stimulus. Prior to the enactment of CAMA 2020, netting provisions in transactions, documents and agreements were not protected and enforceable in liquidation. Transactions in the Nigerian financial markets were inefficient and cumbersome, as every transaction was treated independently, and these undermined the development of the counterparty portfolio with its attendant beneficial pricing and efficient use of collateral. The inclusion of netting and bankruptcy remoteness provisions have, however, addressed these legal deficiencies and made the Nigerian financial system more attractive. This is expected to boost confidence in the Nigerian financial market, galvanize foreign capital inflows, and increase participation in the demand for certain financial products and services, such as repurchase agreements, securities lending, derivatives transactions, and collateral management services. As much as I offer no guarantees and would not like to stimulate false hopes, I certainly believe in what Jim Collins in his book, Good to Great, called the flywheel effect, which I will now discuss as I round up. Imagine a huge, heavy flywheel mounted horizontally on an axle or shaft, and you have the simple task of getting the flywheel to rotate as fast as possible on the axle. Pushing with great effort, you got the flywheel to overcome inertia and inch forward slightly, almost imperceptibly. After a couple of hours of persistent effort, you were able to complete one revolution with the flywheel moving sluggishly on the axle. You keep pushing in a consistent direction with continued great effort till the flywheel completes the next revolution, then the third, fourth, and fifth. The flywheel builds momentum and begins to move faster with each revolution you complete. Then, at some point, the 100th revolution maybe, breakthrough. The momentum of the flywheel begins to work in your favor, such that without applying increased effort, the flywheel turns faster, compounding your investment of effort and the work earlier done. No, I do not necessarily think the Nigerian financial market is at the point of breakthrough yet, but I believe our ability to break through is much less in doubt than it was a decade ago. I believe that we are closer now than a decade ago to achieving gold, global competitiveness, operational excellence, liquidity, and diversity in the Nigerian financial markets. While the Nigerian financial markets and the economy in general has remained painfully susceptible to external shocks, I have reasonable assurance that the combination of our historical resilience and the two stimuli earlier discussed points the Nigerian financial markets in one direction. The road from here only leads upwards and forward, however bumpy it may be. I see a future of a globally competitive Nigerian financial market underpinned by a viral repo market with collateral management, a budding derivatives market, and a credible equity market, and a liberal FX market. Thank you for your rapt attention.
Thanks so much, Ayodele, for that very, I think that's very detailed. You took us from the past to the present and what we should look forward to in the future. I mean, while you're still here, Ayodele, I mean, you need to stay on because we're going right into the first panel of today, which is a panel discussion on the stock exchanges, right? And to join me in on this panel would be yourself. I mean, you've been introduced, but to join myself and Ayodele will be Jude Chemeka. Jude, nice to have you. Thanks for coming. Jude Chemeka is the divisional head trading business at the NGX Exchange Limited. Jude has been around for a while and is moved around. So, and we are expectant that in this panel we would dive into how the exchanges in Nigeria are fared last year, this year, and what are other things to look forward to. Thank you. Welcome one more time, gentlemen. So my first question, and I'd like you to take turn to answer, is I think someone highlighted a couple of times yesterday that the NGX, which as of last year was the NSC, had the best year in the world for 2020, which was very, amazing, knowing that 2020 was a very difficult year worldwide. So I want, and the same thing for FMDQ as well. I know that from the start that we saw, FMDQ did well last year. But starting with Jude, what would you attribute such impressive performances, that's the Nigerian stock market saw last year too? And the follow-on to that would be, how do you think this could be sustained? Over to you, Jude.
All right, thank you so much, Abdul. Let me start by thanking the organizers, AACN, for inviting us to this conference. I think it's very apt, pretty much in line with global expectations as well. To your question, you'll recall that prior to even the COVID, the exchange had been talking about the fourth industrial revolution. Clearly, that was underpinned on the technology. There was a need to have a robust technology to drive financial markets, just in line with other jurisdictions. And that played out significantly during the COVID era. We had a very robust business continuity plan, which kicked in almost immediately as soon as we recognized the health crisis that was emerging and the impact it was going to have. You recall we're one of the first institutions to go remote, largely because the infrastructure and the technological investment to do that was already something that Exchange had worked on previously. So that whole technological backbone gave the impetus to go remote, and we've been working remotely since that time, even up to now. But for the larger ecosystem, we were also very instrumental, even in drafting and helping to codify the sort of business continuity response to the emerging threats. For the brokers, it was very easy for them to comment because prior to that time, there was a lot of investment, even in their operating OMS, as the exchange pushed for minimum operating standards. So they had the technology. What we then augmented was the virtual private network, which was very instrumental in helping the market to stay on, even during the critical period of entire lockdown as brokers were able to trade on behalf of their clients from their various homes. One thing again that we did during that period was to more or less create products that would help galvanize investment for clients. So we revamped our X-Data portal, which is largely a market data portal to allow investors have access to real-time online market data, which was very instrumental in guiding their investment decisions. So the sort of investment decisions that you saw was clearly on the back of well-informed data that the clients were using. And clearly, there was a lot of capacity building. We did organize a lot of webinars during the period. And all this was just to enable clients look at other ways of mitigating the risk that was emerging. As you know, the exchange itself, it's a multi-asset stock exchange, a multi-asset exchange. And so we have other products other than the regular equities. We have exchange traded products as well as fixed income securities. And so there was a lot of capacity building to allow investors navigate and determine the sort of assets that was best suited for their investment objectives. There was also the issue of divergent or moving to alternative assets like the ETFs. There was a lot of interest in the new gold ETFs, which gave significant return to investors as they were all looking to diversify the risk within the market. So all of this, to a large extent, was really what contributed to the sort of performance that we did see in the market. On the macro side, the exchange continued to play a key role in terms of market advocacy, which we did see the effect of the policy that was also very favorable for investments in equities market. And that was one of the reasons why we saw the sort of surge in the market. But prior to that, you'll recall that the exchange was also committed to managing the macro architecture of the market. We had already adjusted the minimum volume or value of transactions needed to move prices. So all of that in combination catalyzed the sort of returns that we saw in the market. And what are we doing to maintain this sort of performance? Clearly, we'll continue to deepen the market in terms of capacity building. We'll continue to also advocate for the right policies to be in place to sustain investment in capital market related activities, and that we're taking very seriously. We'll also continue to push for technology. Clearly, that becomes the bedrock really for sustained performance in the future. Thank you.
Thanks very much for that very detailed. I mean, you read my mind. I think you already answered some of the follow-on questions I could have asked you. And I think well done to you guys at the NGX. I mean, the results didn't just come. I mean, you guys, you really worked for it. Because we are pressed for time, right, on this panel, if you can combine some of the things that you would say help the FMDQ, and specifically the key or top market development initiatives, right, that the FMDQ group, right, is working on, and what to expect in terms of the future. I would love if some of those initiatives would tie into some issues that have been flagged both yesterday and also earlier today. But I don't want to be preemptive. So I would just like you to talk us through how the FMDQ has fared, what you've done, and the top key things you're doing, to ensure that the market is ready for more accelerated growth. Thanks, Adele.
Okay. Thank you, Biodun. And to be honest, our performance in 2020 was not fantastic. In actual sense, I would say it was a mixed bag. And for us, the upside was based on the need of our clients to manage the increased risk they saw in the market, and in a bid to externalize all of these risks as a whole. For us, that was exciting. Our participants were now able to manage their risk better, and we've always tried to do this in our agenda, to drive or to de-risk the Nigerian financial markets for the benefit of our participants as a whole. On the downside, there was significant illiquidity in the market. So again, that posed a bit of a challenge. And we're optimistic that the various monetary policy management tools will drive or restore the liquidity and confidence that is required within the market, taking it forward. But then speaking to what you're talking about, what initiatives we're working on at the moment, we're working very closely with the SEC right now to drive and improve the depth in the market, like I spoke to earlier on. And you're aware we obtained our CCP license sometime last year. And for us, that has spawned the critical initiatives around the derivatives market and the repo market. Now, why the choice of these products? For us, one, these products will significantly drive liquidity in the market and enhance the risk management capabilities of participants. And all of this, we believe, are critical in positioning the Nigerian financial market to attract global capital or make it globally competitive for market participants.
Hey, thanks so much, Ayodele. I really wish we could go on. I know that there are more stuff you guys would have loved to, but thanks so much. From some of these things you've said, we can see that you guys, as the senior management of key financial market infrastructure in Nigeria, are not resting on your oars, and we can say that we're getting set. I mean, just to say that I think the AACN, as we've done in the past, more than ever, will be there to support, in all of these key initiatives. Thank you, gentlemen. We hand the baton to Adebola, our anchor for today. Apologies, we took a couple of minutes more. Thank you.
That's fine. Thank you very much. I really wish we had more time, but I know that we're all busy people here. So we would love everyone to get back to their work to time. So we would go straight into the next panel session. We're still discussing with the CSDs and the depositories. And we have the next panel session, which will feature the CEO of the Central Securities Clearing Systems. We would also have the CEO of NASD and the COO of FMDQ Depository Limited. So that's for CSCS, Aruna Jalo Waziri, for NASD, Bola Ajomale, and for FMDQ, Emmanuel Alao. And that session will be moderated by my colleague, Benedict Adomohai. Thank you so much.
Thank you very much, Bola Adebola, for handing over the button. So in the interest of time, we have just about 40 minutes to get through a lot of material, but let's see how we can manage that to deliver upon what we want to achieve for today. So this panel discussion is focused more on the plans and the initiatives of the key capital market operators within the capital market. And joining me for this discussion are from the NASD, Mr. Bola Ajomale, who is the CEO of the NASD, sorry. And this is the official OTC exchange for unlisted equities in the market. I think they have been around for about 10 years. So we'll hope to hear about some of the things they're doing there, which interest our foreign clients. I also have Mr. Emmanuel Alao, who is the Chief Operating Officer of the FMDQ depositories. I think they rolled out the depository service about 3 years ago, and would also like to hear from them some of the things that we're seeing and should expect. And then from the CSCS, representing the CEO is Mrs. Onome Komolafe, who is the divisional head of shared services at the CSCS. She will be representing Mr. Jalo. We have apologies from him due to a last-minute entanglement. So we'll just have this panel discussion quickly to address most of what we want to address. So you are welcomed, Mr. Ajomale, Mr. Emmanuel and Mrs. Komalafe.
Thank you very
So
much.
going straight to the meat of the discussion, I'll start with you, Mr. Ajamale. Yeah, I'm sure that you saw a gap in the markets, in the securities markets, which fueled your reason for launching your OTC exchange. So we'd like to know, if in terms of the objectives that you wanted to achieve, how many of them have been achieved, and especially those that are focused on foreign investors. And as a corollary to that question, in terms of developments which would benefit such investors, what are some of those things that you're planning, which they'll be interested in hearing about?
Okay, so thank you very much, Benedict, and great to be here. And we've missed these sessions, so this is a great opportunity for us to rub minds and explore how we can expand our market, make it more attractive, make it de-risk it, as well as improve returns to investors. What we saw when we were starting off was the fact that there were some companies that were quoted on a stock exchange, but there was also a very wide gap in the market of enterprise that was going on all around the country that was not being traded in an organized platform, essentially the equivalent of what you have today as the dark web. There was, a whole field of investment activity that was going on that wasn't really being captured, wasn't being reported, very little transparency, and as a result, the liquidity was not as it should be. Again, that created a certain amount of settlement risk for investors. It also created a certain amount of doubt as to whether you'd actually get your returns or even get the investment that you want to get into. So it created a certain amount of risk for portfolios themselves. What we then did was we created a market that was parallel essentially to the Nigerian Stock Exchange. So any security that was trading on the Nigerian Stock Exchange was not a target or not essentially of interest to us. It was really broadening the market. And I heard Ade talking about deepening the market. Well, our approach was to broaden the market and cover all those securities that were not essentially in a structured exchange. To what extent has that been successful? It actually has been a very interesting journey. We have seen, in some instances, even 70-year-old TLCs that have been in the country for that amount of time that have never been on an exchange, and we saw their shares coming in. We've seen shares of young companies, almost startups, coming into the market. So it's been the whole breadth of companies. We've seen financial markets, manufacturing companies, and every other kind of company, the fintech industry, the power industry. We've got securities from those industries in. What we did in our approach was to make it easy for these companies to come into the market. And our focus essentially was more on broker responsibility. And so there was a lot of transparency, a lot more transparency, a lot more liquidity coming from the broker transparency issue. And for the companies, we believed we set a first rule to say any company that was coming into the market had to be SEC registered. That was really the base. Once it was SEC registered, it is under some kind of regulation, then we can bring them into the market. And so we had a lot of success in bringing in very quickly. And right now we've turned over about 45, 50 companies that normally were not in an exchange. Now, what we did as well was we made it easy for those companies to go out of the market should they want to. And we saw a lot of activity, not so much on the portfolio side, but on the direct investor side. And so we saw large investors coming in, either taking over a whole company and buying it out and converting it to a limited liability company. Or we saw instances where some large investors would come in and want to sell down, and so they sell down their interest to the market through the NESD. So we've provided a very important conduit by which companies can either come into the capital market or leave the capital market because of maybe because they're scaling down or changing their structure. And we have provided that conduit for it, ensuring that at the end of the day, the most important thing is the seller gets his money and the buyer gets his shares.
Thank you. Quite interesting. Okay, going on to Mr. Alao. So, from your perspective, FMDQ depository, would like to also hear about some of the things that you plan to do. And as a second part of that, we also want to talk about ISIN. Yesterday during the session, the foreign investors highlighted this as one of the pain points that they have had. And I know we have worked together as an association with the FMDQ to try to basically agree on how this should be used for both trading and settlement. So in your view, we've struggled to find consensus. What do you think we need to do going forward to be able to come to an agreement as to how to address this, that would be acceptable to all parties?
Well, thank you very much. I would like to congratulate the association on organizing this program. I think it's been well put together, and I'm sure people are taking great point and good lessons from what has been discussed. From FMDQ depository perspective, we started operations, as you know, in terms of age, we're the younger depository. We started operation a short while ago, and very quickly, we've established ourselves a credible depository in the Nigerian capital market. We focus very clearly on operational capabilities and excellence, risk management, and also working with participants to ensure that the pain points in both primary and secondary market activities are basically addressed and taken away. In the short term, we're interested and we're focused on ensuring we have third-party certification of our operations and risk management structures and processes. Popular things we talk about, Thomas Murray, ISO standards, secure messaging, integration with all participants, and ensuring that we can drive processes in a way that benefits everyone that touches our platform and participates in the markets that we operate in. For the ISIN issue, I think there's been a lot of discussions and very detailed engagement with the association, participants, and stakeholders with respect to this issue. We understand the need for standardization, and the important thing, though, is that we need to understand local nuances, and we need to understand the implication of adopting practices that may have negative consequences on the market as a whole. There are two key issues here, all right, that we need to look at. Market trading is based on maturity dates. That is a convention that we cannot just change easily. The practices built around this, there are issuance of security standards that are built around this. And there are also market development and growth issues that will be negatively impacted if this is changed overnight. Interestingly, everyone agrees that market development and growth should not be compromised. And that's a positive for us because we're very keen to ensure we continue to support that. Secondly, sovereign security issues are now done, all of them are now done with ISIN. And retrospectively, as of a couple of months ago, ISIN codes were assigned to all existing sovereign securities, and we have updated on our systems. At this point, post-trade activities are actually done based on ISIN codes. And so there is some adoption, if you may say, of ISIN code, and we're not against that. But adopting ISIN across the whole life cycle of trades at this point is not something that the market is willing to go through with, because, like I said earlier, because of the negative consequences. So what we have positioned ourselves to do is to support the post-trade activity from ISIN fully, support our participants in terms of their understanding of what is being settled and what exactly is being traded, and ensuring that there's no compromise to that. However, we will continue and we will support the adoption of ISIN across the whole value chain once the right conditions exist, and we'll support and facilitate that. Thank you. I hope that answers your question.
Thanks, Mr. Emmanuel. I think we'll still have some comments on that, but what I would like to appreciate the FMDQ for being collaborative with the AACN in trying to find a solution, even though that is still elusive at this moment, but I'm sure we'll continue to collaborate until we come to a consensus. So in the interest of time, going to the CSCS, Mrs. Komalafe, I think the CSCS has always supported our initiatives, and you're always very willing to speak to investors on some of the things that you're doing to develop the markets. Particularly, I want to raise the issue of APIs. I know you have developed an API to automate the movement of securities between the trading and the main account, which has been very well received, and everyone is looking forward to when this will be rolled out after all the testings have been completed. So in terms of other APIs, which will be beneficial to the market in terms of promoting automation and other developmental purposes, what are the other things that you are working on? So that's the first question. And then the second part of the question is that in reality, the API developed to move securities between the two accounts was actually done because we have decided to retain the dual account structure, which we're probably one of the few markets in the world still adopting that. Now, in terms of looking forward, what are those things that we should be doing in this market to ensure that, within 2 to 3 years, we think about or begin the process of moving to a globally accepted and best practice market structure in terms of the account structure?
Okay, thank you very much, Benedict, and good afternoon or good morning to everyone. Again, I would want to also restate the CEO's apologies, Mr. Haruna Jallo, for not being at this meeting today. And so I'll quickly go into the questions that you asked. The first one speaks to CSCS deployments of APIs within the market. As you are aware, one of the ones that we have done, which you mentioned, is around the movement of securities between the trading and main accounts. This has been well received in the market. What we've also deployed is also the account opening API. This also enables brokers to be able to ensure that accounts are opened without any interface, a manual interface with the CSCS. This can be done through a self-service portal that is available to the community. Of course, Portfolio View is also available through our API. We've also deployed APIs around client data updates, documentation, know your customer documentation. This we've also made we've made available within the market. We've also made available as part of our API deployment. One of the things we're working on is also to ensure that the community is also able to validate data directly using the BVN, and we're also working on a new initiative in terms of the NIM validation, working with NIMC on that. So there's a lot of deployment around API coming from the CSCS, and this is just part of our own overall initiative to make sure that we are able to ensure that the market is exactly where we expect it to be, and that is an alignment with global standards, as it were. And then going on to your second question, especially around global standards and the fact that we still maintain a dual account structure within the local market here. The CSCS, if you remember, led the market committee on looking at restructuring the current process of dual account to a single account structure. And right now we're also engaging the regulator in terms of the output or the outcome from that committee, working with representatives from various sections of the community. So what exactly would stop us today, for example, to just go on to a single account structure? Part of the work that we did leading that committee was to go into other markets, global markets, to find out what's the structure like, why is that different from Nigeria? And one very key thing that stood out in these reviews was the fact that, for example, the trade guarantee fund structure in those markets is quite different from what we have today in our local markets. And so it's important that we will need to review that structure from what we have today. We will need to increase the number of participants or expand the pool of contributors to the trade guarantee fund as we know it today. So that would make for, at least lay a foundation for the effective transition to the single account structure. And then another thing we also need to look at in the local market is also that there has to be credit lines for all relevant dealing members. Theoretically, we find that may be the case, but we also know that in practice, not all relevant dealing members actually have these credit lines. Again, looking at other markets, we realized that this was something that was considered sacrosanct in most of these markets as a basis for single account structure. And so that's also something that we will need to deal with in our own local market. And then thirdly, we also need to look at our trade correction framework. Today, we operate a no-face trade market, and which works very well. We would want to maintain that. But if we want to go on to a single account structure, we would want to look at a position or some process that ensures that our trade correction framework and there's some post-trade allocation window so that there's resolution of trade execution issues that may arise as a mitigation for potential trade failures. Of course, that also speaks to the fact that you have to have a very good trade confirmation and default management process. So in summary, when you speak to the single account structure, you would want to ensure that your trade guarantee fund process is expanded from the current set of contributors that we have. You want to ensure that you have credit lines. You want to ensure that you have a trade confirmation process. These are things that as part of our committee recommendation, we have recommended that this should be done in a very structured way over a certain timeline. We're looking at a 3 to 4 year timeline to ensure that all these are put in the market before we decide to go on a single account structure within the markets. Thank you very much.
Thank you, Ms. Komolafe. Yeah, and I think the items that you have raised are quite critical and need to be addressed before we move to a single account structure. However, we might differ on the timeline required to achieve this, but I'll leave that to the audience to probably discuss during the Q&A session from them. Before we throw the lines open for the audience to ask questions, I'll just ask my last question, and this is directed at Mr. Alao. So with respect to RTGS and S4 platform, I'm sure you'll agree with me that over the last couple of months, we have been experiencing a near daily downtime on this platform. Agreed, it's not an FMBQ platform, and you may not be responsible for it, but you collaborate very closely with the central bank, and your activities are impacted by the downtime experienced on these platforms. Do you have a view on the cause of this? Because none has been provided up until now. Do you have a view on what the cause is, what the root cause is for these frequent downtimes? And what do we need to do as a market to address this and make it a thing of the past?
Thank you for the question. I think it's a point of interest to everyone, and I'm happy that it's been brought up during this exercise. Basically, what is perceived as system downtime in the market may not necessarily be system downtime. So I just wanted to kind of set the background to this a little bit. Unavailability of systems or delayed operation or settlement cycles could be as a result of a number of things. They could be because CBN is attending to policy issues. They could be because of general health, market health issues that CBN is attending to, or they could be technical issues. Now, when we talk technical, we could be talking about network or the S4 and RTG has been unavailable. Since January, we've taken note of 6 instances of system unavailability and 1 instance of actual system being down because of some work that CBN was doing. However, it's a point of interest, like I said to everyone, and we've been engaging CBN on this to ensure potentially there's more transparency around why system is unavailable so that everybody understands what's driving it rather than the general perception that system is down. And when system is down, to again communicate clearly about what is referred to system downtime. I can also tell you in this instance that CBN is working on certain upgrades and improvement to their systems, which I believe they will be coming to market in short order to inform the market about. Bottom line, what I'm saying basically is that unavailability of systems is not necessarily a technology or system downtime issue. It could be a range of issues that is leading to this. And we'll expect that there will be more transparency on communicating very clearly to market, either through financial market infrastructures or directly about the cause of such unavailabilities.
Thank you very much, Mr. Lau. Thank you for very honest feedback. Okay, so in the interest of time, I'm going to throw the floor open for the audience to ask 1 or 2 questions. So if you have a question, please indicate by raising up your hand, and we'll unmute you so that you can ask your question. Alternatively, you can type your question in the Q&A facility, and we'll ensure we read that out. So we have 1 question from the audience. It's from Mr. Olu Oshineye. Mr. Olu, could you please unmute your line and ask your question?
Sure. Can you hear me?
Yes, I can.
Great. Thank you. So I have a couple of questions for the FMDQ as well as the CSCS. So my first question is to the FMDQ in relation to ISINs. I'm not sure if you listened to me on the panel yesterday with Ademilola, but my question is in line with ISINs. So can you please elaborate? Can you please elaborate on the negative consequences, considering ISINs have been used for more than 40 years in over 100 markets? So throughout the full securities transaction life cycle. So I'm trying to understand what these negative consequences are that prevents you from adopting an ISIN. Also, it's very important to bear in mind what happened in 2019 due to all the confusion caused around the accuracy of holdings. So that's my question to the FMDQ. I'd like further clarity on that. As for the CSCS, in line with the removal of the dual account structure, it's great to see that the CSCS collaborated with the market to look at this. So I've seen your summary findings, and there are a few questions, or shall I say clarification, that's required on that side. So firstly, why did the Nigerian market not reach out to markets in the Middle East like Bahrain, Qatar, UAE, who also currently adopt this dual account structure and are currently looking at replacing it? And you could also have reached out to Saudi Arabia, who have also adopted the dual account structure, but have now moved away from it. That's my first question to the CSCS. Another couple of questions for you.
Sorry, Olu,
Yep.
sorry. Hello, Olu.
Yep.
Sorry, in the interest of time, we have less than 8 minutes left.
Okay.
So can we just let them answer this and let anybody else that has a question
Okay,
also the
no
opportunity
problem.
to ask questions? Thank
Okay.
you. So Mr. Lau, please, we'll take your response first and then the CSCS next.
Thank you. I think there are the two questions about the negative consequence of use of ISIN in the way that for the full life cycle. And the second is, I believe the event he's referring to is a bifurcation of the OMO and the T-bills, I believe. If that is correct, please indicate. If not, please let me know. Now, on the negative consequences, like I said earlier, the trading is done on maturity dates. The size of issues affects and influences debt and liquidity in the market, and therefore growth and development. We believe that the size of issues should be at least 75 billion for each sovereign security issue for the right level of liquidity and debt to be maintained in the market. This is not the case, and we'll find that in certain, securities are issued on a maturity date and there's tapping through the life cycle, through the life of that security. So if the market begins to adopt the use of ISIN to trade, there'll be fragmentation. That fragmentation again will lead to the blowback on liquidity, debt, and therefore the growth of the market. That's essentially what it is. When we get to the point where the size of issues are large consistently across board, I believe nobody will argue against adopting ISIN. That's the first one. The second point, I believe, is on the bifurcation of T-bill and OMO bill. Is that correct?
Correct.
Okay. So the issue of the bifurcation is not an FMDQ issue. It's a CBN policy position that drove this point. But it's been communicated, there's been engagement to ensure there's clear understanding of implications of actions and potential damage to investors and to the investors' portfolio. I believe that there will be more engagement based on the interactions we've had going forward on this nature of decisions. You can be sure again that we continue to engage with all stakeholders, including CBN, to ensure that this market continues to be very healthy and supports the aspirations of investors and market participants. Thanks.
Thank you, Mr. Emmanuel. So I'll hand over to Mrs. Kamalafet to take her response.
Okay, thank you. Thank you, Mr. Oshine, and thank you for the feedback in terms of the work that was done by the Single Account Review Committee. And you said, why did we not go to markets like Bahrain, Qatar, and the UAE and all that? Yes, we did not go to those markets, but in terms of our findings, and it's a good thing you said you've seen our summary document around our findings. You will find out that what we had stated in that document is not very different from the markets that we looked at. We looked at Egypt, we looked at Ghana, I think we also looked at Kenya outside of what we have. And so you still have the structure. And why did we choose those markets? We chose those markets because, one, in terms of the market structure that they operate is similar to what we have. And secondly, in terms of the number of participants and the way their community is similar to ours. And so we felt if they are on a single account structure, or if this is what they tend to do or they're doing, let's see how it's being done. And then apart from that, in terms of our finding, even as a committee, you will find that those markets that you've also mentioned, things around the trade guarantee fund, the default process, are very different from what we have in the local market. And that's what we're saying, that we need to put those structures in place before we begin to say that we want to move from one type of system to the other. Of course, we are open to looking at those markets, but I can assure you that based on the amount of work that was done within that committee and what we came out with, you would find out that those same issues that we have stated are germane to most of these markets. And if you don't put those structures in place, you would probably have to deal with operational risk issues that you don't want to deal with. And that's why I think that is what is important. We can't do all the markets, but the markets we did probably speak to those markets that you're also profiling. Thank you.
Thank you, Mrs. Komolafe. Your line, well, from my end was breaking a bit, but I think we got the gist of your response. Okay, so looking through, I can't see any other questions up or anybody's hand up. But our time unfortunately has run out. So I want to thank the panelists, Mr. Ajomale, Mr. Lau, and Mrs. Komolafe for taking out time to attend and respond to questions very candidly. I think your responses are very, very interesting. But one thing that sticks out is there's a dedication towards growth and development of the market, which we all appreciate. So a big thank you to you, and we look forward to future sessions to speak with you. Thank you. I'll hand back to Adebola.
Thank you very much, Benedict, and thank you to all our panelists on that session. I think it was a very insightful one. We are good with time. Thank you very much, everyone. And we will move straight to the next fireside chat, and that is on the derivatives clearing and the focus of the CCP in risk management. And our guest for that is Ayodele Onomi again, and Tapas Das, the MD CEO, NG Clearing Limited. And our moderator is Taiwo Shonola for that. Thank you so much. You can have the floor now, Taiwo.
Well, thank you for the introduction. Thank you. And today we have an amazing panel where we'll be talking about derivatives clearing and the focus of the central clearing counterparty. And to do this, I have the pleasure to introduce to you Mr. Tapas Das, who is the MD CEO of NG Clearing. He comes with over 25 years of professional expertise in the areas of banking and capital markets and what have you. And also on this panel, I have Mr. Ayodele Onomi, who is the MD of FMDQ Clear Limited. Thank you for honoring our invitation. But before I start with the questions, I'd like to congratulate both FMDQ Clear and NG Clearing on receiving the Securities and Exchange approval in principle to operate as a central clearing counterparty. And so without much ado, I will start with my first question. That goes to Mr. Tapas Das. Mr. Tapas Das, good morning, you're welcome. So my question to you is, what does this essentially mean? What does the central clearing counterparty mean for the capital market? And what are the derivatives in focus for the CCP, and when do we expect commencement of full operations? Thank you, Mr. Das.
Good morning, and thank you for having me. Before I start, I wanted to make a small correction. As of yesterday, we received the final approval, so it is no more in principle.
Congratulations, congratulations.
Thank you very much. So now coming back to your questions, there are two of them. First one is, what does CCP bring onto the play table? And the second one is about the products. Now, as you may be aware, in the current structure, where there is no CCP in Nigeria, all trades are bilateral, and the counterparty risk is assumed by individual parties. With the introduction of CCP, all these counterparty risk will be assumed by the central counterparty through a process called novation. That means if two parties are trading, they need not worry about the counterparty risk. They'll be simply facing to the clearing corporation. So that is the biggest advantage. And the other point is it brings in more efficiency. As you know, in the current process, because it is bilateral, there is not much of netting that happens. Whereas with the central counterparty, there will be a lot of netting, which will bring in essential efficiency in the system. So these two are the main things that the CCP will bring onto the plate: the market safety and integrity and efficiency. Now coming to the second one, in terms of products, though we are mandated as a multi-asset class clearing corporation, because derivatives is new to the country, we intend to start off with index futures first, and then follow up with single stock futures, commodities, rates, and forex. In terms of launch, we have just received the license, and we are almost done with our software. Hopefully, we will start the pilot in a couple of months, and then finally go live either by the end of third quarter or latest by the first week of October. Thank you.
Thank you, Mr. Das. That's very interesting. And so, Mr. Onowumi, how is the CCP structured to best meet the clearing and settlement needs of the dynamic and growing financial market in Nigeria? And what is the mid to long-term forecast?
Okay. All right. Thank you very much, Taiwo, and good morning once again. In terms of how we are structured or positioned to meet the needs, the clearing and settlement needs of the market, essentially we have a three-pronged approach in addressing this. And it's largely hinged on three things: ensuring settlement finality, ensuring settlement certainty, and ensuring settlement irrevocability. And how do we hope to achieve this? We would leverage technology. Again, as mentioned earlier on, we need to be able to drive speed and efficiency within the system. But in addition to that, we're leveraging a robust risk management framework and franchise. And the objective of this is to reduce the unlikely outcomes or undesirable outcomes that market is concerned about. But at the peak of this all is the financial capital or financial resources available to the CCP. And essentially, what this does is it gives further confidence to the market and drives capital efficiency for the market participants. All of a sudden, the market participants do not need to take as much capital charge as they take on bilateral transactions or exchange-traded transactions within the market, because there's a CCP that's sufficiently resilient in the middle of the transactions, having novated these transactions. So essentially, those are the things we are looking at in addressing the needs of the market at this point in time.
Okay, so what would you say is the single most important function of a CCP, and what do you perceive as the most important, perceive that the market would like to see?
Okay, the critical role of the CCP is to drive this settlement certainty. Now, market participants will trade in the market. Now, unlike spot markets where you trade today and settlement is T+2 or thereabout, with the derivatives market, settlement can be as far as 60 days or even 60 months. The concern in the market is what would happen at that future date if the counterparty, whether for reasons beyond its control or intentionally, is unable to come through with what is due from him. Now, what the CCP brings about is that settlement certainty, that come what may, at that point in time, your settlement will be done. Now, the truth about this is when the markets are calm, it might appear that there isn't much of a requirement for it. But again, it's when the tide goes out that we know who's been swimming naked. So essentially, that gives the participants that assurance that come what may, in the long run, they have no worries or concerns about whether the transactions will be settled. And again, what gives the CCP that impetus to tell them these transactions will be settled? It's the resources available to it eventually.
Thank you. So, Mr. Daz, what do you see as the key legal risk management items relating to CCP? Do we have all the required laws to support operations, i.e. netting, insolvency, etc., etc.? Mr. Daz?
Thanks for that question. In fact, if you asked these questions 2 years back, we would have a lot of concern. But as you know, the new CAMA 2020, it contains a netting provision, which allows us to ring fence the collateral that we receive from the members to use for settlement. With that provision in place, I think this the legal provisions are quite okay for this insolvency purpose. That means the collateral that we have, we can use it for the settlement purpose and nobody else can use that. So I think we are good for now. Thank you.
So following up from that question, so how would the CCP manage risk if one of the counterparties becomes insolvent?
Okay. Now, before I get into the insolvency, let us look at the previous steps, whether at all CCP will allow a member to go insolvent. As you know, before even the trade is placed, we will have an initial margin, which will be based on value at risk. That means we collect the maximum possible loss by doing some kind of a back testing. We collect that number from the member. Assume that we have collected, but during the day, again, the prices fluctuate a lot. We have an end of day map to market, which we collect. Now, so fast 2 steps are gone. And during the day, we monitor the position on real-time basis. And then when the member takes the exposure, we do monitor on a real-time basis. And then based on the position, we take actions. If all these 3 fail, we have the membership deposit. If the 4th one fails, we have the settlement guarantee fund. Now in settlement guarantee fund, there's some kind of a waterfall. That is, we use it step by step. For example, even the clearing corporation or NGCL will have a skin in the game. We provide some money. We have money of the members. And we also mutualize the loss in the extreme case. So with all this, I believe there is no risk to settlement. Thank you.
Thank you, Mr. Daz. I'm sorry to ask that question. Guess I put you on the spot. Okay, so Mr. Naomi, so what depth of default or guarantee fund do we expect from the CCP?
Okay. Regulatorily, the capital requirement from the SEC is about 5 billion naira. That's about what, $10 million. But what we've been able to do in FMDQ, working closely with our board, is at the moment we have in place about $35 million in our own default resolution reserve. And the idea is, with the directive of the board, is to take this to about $60 million in the near future. Now, the idea is simple. The purpose of this, like as mentioned earlier, is to drive that certainty or comfort within market with the market participants. So yes, that's what we expect to see from the CC.
So for this 35 million, where is it from, if I may ask? They are trying to grow to 60 million.
Where is it from?
Yeah, I mean, you said you currently have 35 million and you're looking to grow it to 60 million. Is it from contribution from member participants or from where?
Okay, no. What we have, the 35 million I speak of, is the CCP's skin in the game.
Okay.
Own contribution to ensure certainty and integrity within the market.
Okay. Okay, thank you. My final question goes to both of you, but I'll start with you. So how do you intend to attract local and foreign investors seeking a diversified portfolio within our market?
The way I would look at it, or the question I would ask is, what are participants looking for when they approach the market? I think it's two things. One, does it make sense? That is, what does it cost to purchase this hedge? We need to ensure it is narrow enough that it's price efficient for them, but we also need to make sure it's big enough so there's not drive unnecessary risk taking within the market, and then sufficient to cover in the unlikely case there's a default. But the second question is it safe? As and when will I get value? So the way we look at it, we think those are the things the investors, foreign investors would look at. And once that is put in place, once we can answer in the affirmative those two questions, I think we'll be able to meet the needs of local and foreign investors. Remember what I said earlier on, that look, for the foreign investors, right now, what we have are instances where it costs them a whole lot more to transact with counterparties in Nigeria. And this cost is in terms of capital charge. But by the time you have a CCP novating these transactions, all of a sudden, and this CCP, the critical criteria it has to meet, one is global acceptability. Once it meets those requirements, they will trade through or with this CCP as a counterparty. All of a sudden, the significant costs in form of capital charge reduces. This, I think, will drive capital inflow into the Nigerian economy.
Thank you. So, Mr. Das, what about you? I'd like to hear your own views as well.
Sure, thank you. Apart from the counterparty risk, which the other gentleman spoke about, the one more thing I note, I have spent almost a year in this market, that is the forex risk. Now, as you know, we do intend to start forex derivatives. So whether it is local or whether it is global, let us say a local player wants to participate in NYMEX contracts. Obviously, without the certainty of the forex, it will be very difficult. So once we have the currency derivatives, maybe that is taken care of. Same thing with the global players. When they bring in money or take out money, once they can settle through some kind of a derivative, they have certainty, maybe that will encourage them to participate in this market. So we are looking keenly at the forex derivatives being rolled out, apart from the other points mentioned. Thank you.
Okay, thank you. Thank you. Let's find out if there are questions. I'll just check. Okay, I have a question from Dr. Joe Mekulua. Okay, the question is, describe the process after novation till the eventual settlement of the underlying settlement of, I don't know, sorry. I'll just take that again. Describe the process after novation till the eventual settlement of the underlying securities and the corresponding cash. Explain the CCP process with the CSD and the settlement banks at this stage. I don't know if you got that question from Dr. Mekulua.
Okay.
Sorry? Do you want me to repeat? Any one of you can answer, please. Mr. Onohumi, you may start.
Okay, so if we're looking at the process after novation, first, if you look at the novation itself, what has happened is two parties have traded between each other, and the CCP creates a contract that replaces that bilateral contract and becomes the seller to the buyer and the buyer to the seller. Now, over the life of that contract, and again, like I said, it's usually transactions that are longer dated than your spot transactions. What happens is that on a daily basis, the contracts are marked to market. Now, but before the CCP decides to step in the middle and novate, as mentioned earlier on, would have looked at the volatility of the underlying securities or the contract itself, and based on that, taking an initial margin before these counterparties can enter into this contract. So once that margin has been taken, that gives the CCP some comfort. Then the unlikely event that this counterparty default, there's some resource to hold on to. Remember, for the system to even be available to the counterparties, the clearing members need to have put in place a default fund contribution. That's a second layer that was mentioned also earlier on. Now, over the life of the contract on a daily basis, and in some instances, even intraday, depending on the volatility we see in the market, we will mark those contracts to market. And where there's a differential, there's a movement in the market price, because remember, it's a zero-sum game where one is in the money, the other is out of the money. We will take what we call the variation margin on a regular basis, on a daily basis, and then make payments or settlements as it were. So essentially, the contracts on a daily basis are marked to market and reset to zero until the final day of the settlement. Now, between the day the transactions were entered into and that settlement day, the risk exposure is that pre-settlement risk. The concern is that the counterparty would just not show up and give you what is due as a result of movements in market prices. But on the settlement date, which I suspect the gentleman here is speaking to, on the settlement day, that risk now goes beyond just the pre-settlement, but now comes down to settlement risk, where the depository or the CSD ensures or manages that with a DVP infrastructure to ensure that the underlying move at the same time cash is moving. So there isn't unnecessary exposure to counterparties at that point in time. But it's also important to note that not all these derivative transactions are settled. A number of them are non-deliverable. So what happens is that where they are non-deliverable, it really would end at the last day without going into the settlement cycle as referred to here.
Okay, thank you, Mr. Onomi. Mr. Dash, would you like to add more to the question, or are you good?
I think Mr. Onomi has explained it. His last point that he made, which is very true, some are cash settled and some are security settled. For cash settled, anyway, the daily mark to market almost is as good as any settlement. For security settled, those positions will go to the depository, let's say CSCS, for settlement. If there's any specific point that anyone has, maybe we could take that question. Thank you.
Thank you. I don't see any more questions. Okay, thank you, Mr. Tapesh Dash, for your time, and Mr. Ayatollah Onomi. Thank you. We are very proud of what both CCPs are doing. We know that it will definitely transform the capital market. And thank you for sharing your journey. Thank you, thank you, thank you. It's a pleasure talking to you.
Thank you very much for having me again. Thank you.
For your time. Thank you.
Thank you, Kaiwo, for moderating that, and thank you for our guests as well. And we know that the AACN continues to align with with everybody, with every market participant, to ensure that we bring the best for the market at all times. So we are moving straight to the next session, which is on cyber security. This is going to be a session by Mr. Abumere Igboa. So is with Stanbic IBTC PLC, is the Chief Security Officer there. So I think he's on. Okay, yes, it is. So Mr. Igboa, you have the floor, please.
All right, thank you. Good morning, colleagues on the line. Good morning, everyone. All right, so I'll just quickly, all right, now I have control. All right, so I'll present I'll just set my screen. Just let me know when you can see my screen.
Yes, we can see it now.
Oh, okay, good. Okay. All right, I hope you don't mind if I turn off my camera so that I can have a better quality in terms of the present. Are you comfortable with that?
If that would make your presentation better, that's fine.
But I'm audible. I'm audible, is it?
Yes, we can hear you.
All right, that's fine. Okay. Okay, so just jump into it. Good morning, colleagues on the line. Good morning, ladies and gentlemen. So it's a pleasure having me on the call. So I'll quickly try and maximize the time that I have. I'll be speaking today on cybersecurity post-COVID-19. We're looking at the road to new normal. So I'll just jump straight into it. So the slides, I have 5 areas, or rather 4 areas specifically focused on. I'll start with introductions. Basically, if we looking at the whole COVID-19 pandemic situation, we've seen a lot of transformation, especially in the business world, because there's been the need to maintain operations of the business and also be able to satisfy our customers has also led to organizations adopting digital platforms to be able to reach out to their customers. So that has largely transformed the business landscape because in also ensuring that they maintain some of the guardrails or conditions for COVID-19. You have some of our staffs then working from home. And that has now taken the entire business landscape to away from the traditional mode of brick and mortar to then employees working environments at home. So that's the rush to being able to support such structures has also created gaps, and these gaps have then now been preyed on by cyber criminals to perpetrate frauds or some of the criminal schemes. So a lot of what I'll be talking about today, it's basically what we've seen as a result of this transformed landscape, and what then do we need to do to ensure that we continue to maintain confidence in our customers. We're also able to provide assurance within our organizations and ultimately to our board members, our stakeholders also. So jumping into what the threat landscape looks like today. As at the statistics available end of 2020, we had seen that data leakage had reached an all-time high of about 36.1 billion records that were being leaked as at the first 3 quarters of 2020. And this is like, it has doubled what was recorded as at the same time in 2019. We've also seen the types of attacks that are being adopted by criminals today, focused in 3 key areas, and largely is because of the ease in which some of these schemes are perpetrated. It's also in terms of the kind of impacts that some of these schemes have to disrupt businesses. So the top attacks we see are phishing, ransomware, and DDoS. Phishing It's a technique where the fraudster sends a malicious email, and contained in that email, it's a link asking you to provide certain critical or sensitive information, which either take over your identity or then use to compromise some of the information that you have access to. We've also seen a growth in ransomware. Ransomware, it's what we call an advanced malware. And that's basically a technique that has been adopted by criminals where sensitive data is being encrypted, or rather put in a state that is unreadable or no longer fit for purpose. And then the attacker then demands for some form of payment, most especially specifically in Bitcoins, because that's an easy way to move money or hide their trails. And then we have DDoS, which we refer to as distributed denial of service. And basically what this does, it's basically to send large volume of data towards some of your services in which you use in supporting customers, and then disrupt that service from being able to deliver on some of the customer needs by making that channel unavailable for a period of time. So these are the trends and attack types that we see significantly today. We've also seen scenario where the vulnerabilities that are being recorded globally has also kind of doubled. We've seen statistics where you have over 18,000 incidents in which more than almost 50% of that are high severity. And what that means is most likely each of the 50% of those incidents that are high severity could lead to some form of cyber incident or cyber attacks. Then we've also seen scenarios where certain types of what we call protocols, and basically this is speaking to a service in which we try to gain access to corporate resources. We've seen, sorry, okay. So we've seen such scenarios where some of these things are being targeted as a way to breach organizations. So these are the new trends that have come to light, basically because organizations are in a rush to move services to digital platforms to ensure that they're online. They can reach their customers vastly, and then also be able to render those services in a manner that that meets the customer's needs. Going to we've also seen as part of the continuation of the trends, I've just talked about the cryptocurrencies based on ransomware. Cryptocurrencies are much more adopted today by criminals because one, it's not well regulated in this part of the world. It's also a platform in which you're unable to trace or trail some of the identities of these criminals. And that gives them easy access to be able to move some of those illicit funds outside the shores of this country. Then the challenges with privacy. So because we then need to provide the services seamlessly to customers, we then need to either collect some type of information to be able to validate the customer, or we then render certain types of information to the customer to be able to then conclude on their engagement with us. So what Sorry, there's a hand up. What's the approach for this?
We will take questions at the end of the session. You can continue, sir. So we would ask for the question.
Okay, all right, thank you. All right, thank you, that's fine. Okay, so yes, so like I was saying, in trying to then support customers today, we then need to provide some bit of information to the customer, and also we need to also collect some bit of information from the customer. What that has also led to is then the criminals now know that we leverage these digital systems to either collect or provide such sensitive information, and they go after those systems themselves. So in such scenarios, we then need to maintain some level of privacy, and that's because we then have privacy regulations today. We talk about the Nigerian Data Privacy Regulation, which kind of stipulates certain guidelines and requirements on how we need to protect customers' information. And then we have that responsibility to ensure that as we provide those services to customers, we then maintain the right level of security of that information. We've also seen scenarios where there's a lot of information manipulation, and basically it's to create that fear and panic. And criminals have also latched into this to then start offering some kind of relief services to victims, asking them for certain types of information or sensitive information, or personal identifiable information, like we call it. And on that basis, they are able to then steal their identities or carry out what we call identity theft, and then go and register for some financial services on their behalf, most likely credit-based financial services. So those are some of the trends we've seen, and that's because the business is trying to also deliver those financial-based services to customers, and the criminals are trying to take advantage of that engagement. All right, so I will talk quickly on some of the recent events we've also recorded. I start with one that we still have quite fresh in our minds, the EndSARS protest. Why certain citizens were trying to kind of reflect their mindset in terms of their feelings towards the brutality around this type of a campaign. The criminals themselves saw that as an opportunity to carry out and perpetrate their own schemes. So we did see a lot of DDoS activity during that period. We did see a lot of disruption to business services during that interval. But I think one of the messages that we also get from this event is that it was quite clear that the criminals are also working together, and they were not in any way working in isolation. So the fact that we had the likes of Anonymous get with quite a notable threat actor get involved in that campaign, has really indicated that these criminals also work closely with themselves. All right, then the other incident that we've seen, which is quite fresh and new, it's the Colonial Pipeline incident. The Colonial Pipeline incident, the impacts from a financial perspective, the management team had paid about $4.4 million in ransom to the attackers. And basically they had to pay that to be able to restore and gain control of some of their systems. The challenges with losing control of such system was quite enormous, in the sense that you could have an unrecorded amounts of resources that were being distributed, and they were non-accounted for in terms of the financial benefits. They were not aligned. And we did also see a recent incident where the North Korean attackers also tried to steal the COVID-19 vaccine from Pfizer. And we've also seen the one with Hush Puppy, the Nigerian notorious cyber criminal. And basically what this just tells us is this act cuts across different geographies. It's not specific to a particular area or location. It's cut across different geographies. It also cuts across different sectors. It's not specific to financial sectors. We've seen incidents from medical, we've seen incidents from the oil sector also. And one other positive information we gather from the recent events is that we are now seeing a lot of collaboration across countries and security authorities trying to combat this crime and trying to combat this particular type of crime. And that's quite noticed in the recent recovery from the Colonial Pipeline ransom, where the U.S. Justice Department got back about $2.3 million out of the 4.4 that had been given out. So I'll just quickly rush into the new normal, noting that I have very limited time. And new normals speaks to what we should be doing to be able to ensure that we have our hands and we are on top of our game around some of these issues. There's that need for ensuring that there's board level oversight in terms of how we manage the risk of cyber. We then need to ensure that we continually promote security awareness within our various institutions. Having in place a security operations center where you have constant monitoring and oversight into the types of behaviors within your environment. It's also very key. So you should be able to determine what is good behavior in terms of your traffic pattern in your organization and what is bad behavior in terms of the behavior of some of your assets within the organization. Then having an established incident response framework, it's also very key. And this looks at it from two folds. One is the fact that you need to have some collaborative efforts with your internal stakeholders and external stakeholders in terms of incident response. And the secondly is the fact that you need to have services of like a forensic investigator who would then be able to assist in terms of identifying the point of intrusion into your environment, or even helping you with recovery efforts and to be able to take out the bad guys. Then we also talk about the fact that there's a need to always build your defenses in depth. So there's no one size fits all approach to how you combat cybercrime. You constantly need to invest in controls, and this is a dynamic effort because today your control might be effective, but tomorrow when you carry out a different type of business, the criticality of your assets then change, and then you need to realign how you invest and what your control should be. Then we also talk about having a cyber insurance scheme that then gives you some level of assurance and to be able to protect you in the event of an attack. Then having constantly reviews and assessments of your landscape and your business environment so that you're able to identify timely where there are weaknesses and then put in place the right mitigations to be able to address those loopholes before they become exploited by some of these criminals. Then I think finally, it's the fact that you need to have a fit for purpose approach in how you manage the risk. So you need to identify what is critical to you. You need to identify what threats can target your type of business, because not all threats actually affect your line of business. Then you also need to be able to map out what controls you then require to be able to combat those type of threats. Then when you understand those controls, you know what investments are required, and then you are able to then prioritize in terms of what will be most effective and what will also be most valuable for you. So other than this, the final one, it's basically adopting cloud-based security controls to also help improve on the security posture of your organization. I'll stop at this point and then take any questions. Thank you.
Thank you so much, Mr. Abunere. We will take questions now, and we have Olu's hand up. Olu, do you want to ask your question, please?
Yeah, sure. Can you hear me?
Yes, we can. Thank you.
Brilliant. Okay, thank you. So thank you for the presentation on cyber. So my question is, with cyber risk becoming more and more relevant with staff working from home, and I see from your presentation that even the likes of CBN have not been immune from it. With this in mind, are you having any discussions with the SEC regards putting in place a regulatory and supervisory framework to challenge and making it mandatory for banks and FMIs to pursue cyber defense and resilience?
Okay.
All right, that's a very, very valid, very valid question. Yeah. So can I go ahead and respond?
Yeah, sure, please.
All right, thanks. Thank you. Okay, so yes, very valid question. Yeah, so yeah, cyber risk from work from home users remain a major concern, and owing to the fact that that now forms part of your business operating landscape, there's a need to then have full oversight of that. It becomes quite challenging, especially in this side of the world, to be able to control a lot of the infrastructure that you require to be able to support such models working from home. So what then you need to do is then probably set standards and baselines, which you probably enforce as your staffs continue to access corporate resources within the organization. So that then helps manage the risk. But then you need to ensure that you have that full oversight of that aspect. Then speaking to how we're working with some of the regulators, I would say from a SEC perspective, not really had much engagement at that level. But then looking at it from the CBN perspective, where we really have much engagement at the moment. Yes, I look after, in fact, I'm the chairman of the Committee of Chief Information Security Officers for Nigerian financial institutions, and we have regular monthly meetings where we discuss and table some of these issues. And CBN, both banking supervision and the payments systems department, are members of these meetings on a monthly basis. And here we discuss around some of the concerns and then what approaches we need to take to be able to address those concerns. And I would take note of the questions around SEC, and then now try and prioritize or put some bit of action item on my agenda on how we can basically engage the SEC in that regard. But speaking at it from where I stand today, and looking at the type of engagement we had in the last 2-3 years, where the framework was put, the cyber risk framework was put together by the Central Bank of Nigeria, we've been engaging quite effectively with the Central Bank. Thank you. Hello? Sorry, am I still audible?
Yes, you are, Abu.
Oh, okay.
Yes, Debola.
Yes, sorry about that. Okay, so we do not, there's no other question, but someone is asking, an anonymous attendee is asking if the presentation can be sent to participants. I think we would ask all our guests, and the presentation will be shared, right?
Yes, the presentation can be shared. Yes, thank you.
Okay, thank you. Thank you so much for your time, Mr. Abumere. We really appreciate this. I would like to, before we go to the last session quickly, I would like to just apologize. I think the panel session that was taken by Taiwo, we had a couple of questions that were not answered. So we'd like to apologize for that. We missed someone that wanted to ask a question. And what we'll say is we'll take those questions and we would refer back to the panelists and feedback on the answer. I also see Dr. Joe's comment here in the Q&A as well that was referring to the part B of his question. So we'll take that back and we would get the answers back to you. Is that fine? So thank you for that. Apologies for that oversight. So we're going straight now to the last session for today. And I think it's a very hot topic. Everybody's talking about it here and there. Cryptocurrency, emergence of digital currency. It's been on the news. The CBN, is talking about digital currencies already, and not just the Nigerian CBN, even CBN of other countries. So to help us understand a bit more about what is happening, we have Mr. Mobolaji Onibudo is the founder and CEO of Zenbit Digital Transaction Services, and he will be taking this session quickly. Mr. Mobolaji Onibudo. Mr. Mobolaji, sir. Okay.
Yeah. Good morning, everybody. I'm glad to be here, and I want to say congratulations to the organizers. It's been a wonderful session, and today I will be just going over this cryptocurrency session. I'll do so through a deck of slides I put together this morning by sharing those with you. Just a second. Can everybody see my screen?
Yes, we can see your screen.
Fantastic. So I'm sure most people are already familiar with what cryptocurrencies or crypto assets or tokens are, but I wanted to just do a quick definition to those that might still not be familiar with them. Essentially, they are digital or virtual currencies built through cryptography and software that ultimately prevent one of the biggest problems in all efforts of computer scientists in creating digital cash, which was preventing counterfeiting and preventing double spend. So that sort of goes together. So this double spend problem was that if I send you, could be described as if I send you a PDF document and then I still have the original copy, then I've just made copies of the same money, if it were money, and we'll start to have issues with counterfeiting And so that was a big challenge. And what they came up with was a decentralized network, essentially a decentralized ledger, a database, acting as a ledger, which was replicated across the internet. So you have thousands and millions of copies today for the case of Bitcoin's distributed ledger, or rather blockchain. So blockchain is used more when it comes to cryptocurrency, but when you're talking about other assets, it's referred to more as a distributed ledger. So by being able to have a replication of the same ledger, then we're sure that nobody can cheat the system, because they're all in sync. And if anybody tries to maneuver or modify one copy of the ledger, democratically, through the consensus algorithm, that culprit will be forced out of the network or overridden. So that was very important. And in order to do this, they needed high encryption, which is public key encryption, military grade technology, which is till today still impenetrable. You cannot crack public key encryption technology. It would take almost a decade to do the computation. And by then, transactions obviously in the world would have moved far ahead. And then the founders also wanted it to be independent. They didn't want it to be subject to political interference from government or just bad management by, maybe inefficient or incompetent civil servants, or altogether greedy, market actors, like in the case of the subprime mortgage. It was actually at that particular time that they came up with it. So that was the concept behind it. So for regulation, there's been a lot of talk, a lot of row. We've heard a lot of concerns from the CBN suspending banks from providing services to cryptocurrency businesses or individuals. And obviously those concerns are somewhat, reasonable if you think about it. When they brought up the issues like money laundering, KYC, and the typical criminal baiting issues that come up with dealing with banks and moving funds. But really, if you think about it, when you look at regulation, we need to think of the definition of what sort of assets we're thinking about. And in the US, which we follow very much, as you know, the US has the Securities and Exchange Commission, and clearly that's we follow the presidential system, and as well we've adopted the Nigerian Securities and Exchange Commission. They are abide by the Awi test rule, which was based on a case that went up to the Supreme Court, and it was from that case that if a number of definitions, key points were made in that for this definition of what makes a security, and the points are really to consider whether an investment in an asset it requires money, and there's an expected profit associated with the investment. The money investment is it's in a common enterprise, and profit comes from the third party or promoter of the effort. So if you think of Bitcoin, you have to spend money to buy it, and if you're not buying it and you're mining it, you have to spend money to contribute to the network. So it's an indirect way of spending money. There's also expected profit. Nobody's doing it for free, so they're going to make money. And there is a common enterprise. And even though there's no company registered as Bitcoin, but there is an organization which is virtual. And this is how Bitcoin has been able to evade the law, because that issue of common enterprise, the SEC could not actually pin that down on them. But it's very clear, it's still a security. And then of course, profit is expected by the works of the miners and the users. You will make some profit once you mine Bitcoin and sell it. So this is what classifies Bitcoin and most cryptocurrencies to be really securities. And if they are securities really, it is a case for the Nigerian Securities and Exchange Commission. The markets are very volatile. It's very expected. You know, over the years, I know following since about 2016, you know, about 5 years ago, well, seen dips of 38%, you know, 40%. It's not uncommon in this market. So people should never be too worried. In fact, if you see such a dip as Warren Buffett always say, you want to invest when everybody's nervous, when everybody's worried, and you want, excuse me, you want to sell when everybody's over optimistic. So the pattern over the years is that there will be dips, but the overall trend, it's upward because Bitcoin is a deflationary asset, meaning that it's limited in supply, and there will only be 21 million Bitcoin for the entire 7-point-something billion people to invest into. So you can imagine we're not there yet. As of 4 years ago, I told a friend to buy a Bitcoin, which was at the cost of $1,000. And he said, no, it can only go down. And since then, he came back to me and said, wow, it got to 55,000. Is it going to go up higher? I'm like, if it can do 55x in 4 years, do you think it's going to be difficult to do 10x in the next 5 years? Then he says, now I get your point. The bottom line is, you know, in a 10-year compounded annual growth rate, Bitcoin outperforms any assets in any category. You know, so its average annual growth rate, it's just below, a little below 200%. So it is definitely an asset to consider, and obviously one would have to apportion maybe 1 to 5% of one's portfolio or an investment portfolio to keep the risk at the minimum. Now, CBDCs and stablecoins, the central bank just recently announced that they will be introducing a central bank digital currency version of the Naira, you know, which was great. Everybody was happy that, oh, CBN is coming around. So there are key advantages to this. You know, it will make cryptocurrencies thrive more. I'm not sure if that's their intention, but that would definitely happen. Auditing will be easier for them. They can plan better. There'll be cost savings. It will enable financial inclusion. They will have better oversight. You know, all the things they always plan to achieve. Things will be easier for them, but there will be disadvantages. You know, jobs will be at risk, and criminals will always come to the table. You know, there will. You know, when you talk about the issue of ransomware, you know, fraudsters and all these things taking Bitcoin. Of course, everybody likes what's good. You know, if anyone's going to use good technology, it will be criminals. So that also needs to be put in mind. But then there will be a competition between stable coins and central bank digital currency. There's some cryptocurrency known as stable coins that are basically mostly cash backed. So one of the most popular is the USDT. The USDT is backed by about $50 billion by an investment group out of South America. And, you know, they publish their periodic audits. There's also the USDC, which is owned by a company called Circle, with Goldman Sachs being one of their key investors. So the question is, at some point, you know, citizens are going to be wondering, should I just receive USDT or a depreciating Naira? So that is some of the challenges that will come sooner or later. And then banks, what's going to happen? If everything is digital, my money is on the blockchain. Today, I hardly go to the bank. Do they really need all that infrastructure, branches all over the place? So a lot of questions need to be looked into or answered regarding the state of the banks. So again, association with fraud and ransomware, what's good for the gander is good for the goose. I'm afraid to say that, but because everyone eventually adopts a good technology, including criminal. The US dollar has been the most used currency for criminals. Bitcoin still has a very long way to go. So they should stop blaming Bitcoin for criminal activity. Till today, drug dealers don't, out of Mexico, South America, they're not using Bitcoin. They're using billions and billions of dollars. So there will always be digital trails on the electronic medium, including the internet anyway. So you can't get away doing fraud with Bitcoin. It doesn't mean, they cannot be traced. The FBI and now also the EFCC just successfully tracked and apprehended some criminals that used that committed a fraud using Bitcoin. So there's always digital trace, the IP addresses, their wallet addresses, their wallet on spend transactions. That if you dig down and audit, you will eventually find someone at the end of, from the beginning of the fraud to the end of a cash transaction, you will be able to trail. And the FBI has proven this. So it's not completely true that they can't be tracked or apprehended. I think that's all I have the time for. So I try to make it as short and precise and concise as possible. Thank you very much. Any questions, and I'll have answers for you.
Thank you very much, Mr. Onibudu. I think that was very concise and but very explanatory. And I know that a lot of people have better understanding of what is going on in that space. So we have one question in the Q&A box. It says, is there any depository planning to provide a platform for digital assets? Do you know this? And would you like to respond to that?
A depository in the Nigerian market, I am not aware, but definitely a lot of traditional investors, who are not very techie savvy would want this. High network individuals, they will want this. Some of the things that scare them that, oh, if I miss my seed phrase, my private key, I'll lose my money. Let somebody just handle that for me. So I think there's an opportunity in that space once the CBN comes to terms with SEC and there's proper regulation and everybody's happy in the market, everybody has their own share of the pie, then it would be a good time to be ready for providing such services.
Okay, so that would be very regulatory dependent. Okay, okay, I'm just checking to be sure I don't miss any question. Olu, your hand is up, I can see it. Please go ahead. Is Olu there?
You're muted, Olu.
Can you hear me?
Yeah, I can hear you.
Apologies. My question was, I know this is all about cryptocurrency, but can you give us an overview of what's happening in the security tokenization space and whether there are any ongoing conversations with the custody element? As you know, safekeeping of assets is of paramount importance for investors. And you've obviously touched on it there in terms of private keys. You'd want the custodians to actually look after it because that's their bread and butter.
Yeah, I think it relates to the first question. I'm a member of the National Committee on blockchain and crypto assets with SEC. And we had drafted some a regulatory framework as of last year, which SEC had published a position on. So details were supposed to come out later on before the CBN memo or circular that went around to the banks. So yeah, there will be proper regulations for security tokens that, you know, that represent shares or bonds and so on and so forth in the traditional sense as opposed to crypto. And pretty much when it comes to regulation, we also identified, just as they did in the US, there's very little new under the sun, in the sense that only that there will be now digital mechanisms of doing things, but the rules still remain the rules largely. You know, you do need approval to issue a security or do a public offer and so on. And of course, custody, custodial services will always be essential because, as I said, you know, traditional investors and a lot of high net worth individuals and the general public at large are always, a lot of them have a culture of having a safe place to keep their assets, their belongings or their investments. So there would always be a play over there.
Okay, thanks.
Okay, thank you. Okay, we have a comment. I think this is a comment from an anonymous attendee. It states here that the CBN needs to address the reason or reasons why a section of the populace is excluded from financial services, as introducing CBDC may not solve the problem. Financial inclusion can be addressed by licensing more payment service banks that can reach the unbanked. So that's a comment, but do you agree with that, Mr. Onibudu?
It's a two-way street. You know, M-Pesa in Kenya, which is a product of Safaricom, was almost an experimental product. You know, people using airtime credit as a form of payment, and it took off to several countries. You know, M-Pesa is now bigger than any bank in Nigeria you can think of, in several countries around the world being used. So you never really know what's going to catch on with the population or users or the different demographics, those that are unbanked and those that are banked. I think also the fear that, you know, telecoms companies are going to encroach into banking has always been what has kept or prevented a lot of innovation within that space. But there will be natural evolution, and crypto and stablecoins, CBDC, are going to challenge, you know, a lot of the thinking and all the preservation they're trying to do in terms of everyone holding their spaces. And we'll see, you know, at the end of the day, we will follow the trend, the global trend that would eventually emerge. And if crypto and telecoms and everything is all digital, you know, voices go over the telephone on an analog device and becomes digital. So money is digital. So whoever can provide the best services using the technologies that are available to them, they're eventually going to win. You know, regulation can restrict. Ultimately, you know, what it will find is level. And yeah, we would adjust.
Okay. Thank you very much for that, Mr. Onibudu. And that is the final session for today. And I think we did well for time. We were just like 10 minutes over the time. But I'll quickly hand over to T-Maj now. He has a poll just for us to quickly answer. T-Maj, are you there? Are you ready? Before we take the vote of thanks.
Thank you very much, Debola, and thank you to our esteemed panelists for taking us through a lovely, smooth journey, I must say. In a bit to improve on what we've started, this is the first virtual conference that we're holding. We predominantly would hold this at the seat in London. We would like to get feedback from our esteemed guests and attendees, and as such, we have created a poll. We would like you to both panelists and everyone to just fill. It's a 1-minute poll, just to give us a feedback and a feel as to how we fared. Thank you very much for taking time. The poll has been launched. It's a 1 minute, just general feedback about how today went, day 1 and day 2, I must say. If you want to provide a detailed feedback to all to the Association of Asset Custodians, you can send an email to info@assetcustodian.com.ng. I'll take that again. info@assetcustodian.com.ng. That email will be provided in the chat box, so you can provide a full view if you want to provide context. We do appreciate votes that are coming in. Thank you for taking this time. I'll yield the virtual lectern back to Adebola, who would help in closing the session. Thank you.
Thank you very much, T-Maj. Okay, I'm looking at the progress of the poll, so we can keep voting, please, while we take the vote of thanks. First, I'd like to say that we will request for the different presentations from our panelists, and we will upload that on our website. The website address also was dropped in the chat. That's assetcustodians.com.ng, www.assetcustodians.com.ng. We also dropped the e-brochure for you to refer to. So if you have any questions or if you want to reach out to us as well, we've also dropped the email address. So all the panel sessions and all the presentations will be on our website after this event. We just want to say a big thank you to everyone who took our time to be part of this event, day 1, day 2. This is the first virtual conference that we are having. We usually have this in London, but it's the 9th Nigeria Investors Day this year, 2021. So we want to say a big thank you to you for attending. We want to say a big thank you to all our speakers, all our panelists, all the moderators. Thank you so much for the wonderful job done. And thank you most especially to the attendees, for those of us that attended, asked questions and everything. It was, I want to believe that these 2 days have been well spent. They've been very insightful, and we have something to take away. And we look forward to hosting you again next year. Now, I can't say whether that will be in London or, we never know. But we look forward to hosting you again next year. So thank you everyone for being a part of this event. My name is Adebola again. And I want to say thank you to all the ESCOs of the Association of Asset Custodians of Nigeria, from our presidents, Biodun, and also to T-Maj, to Henry, everybody, and a big thank you to the conference committee as well. Thank you for the wonderful job. Thank you all. Thank you all for being here. So I think this conference, I don't think, this conference is now officially adjourned. Thank you.